Hello and welcome to the next video in the FX Evolution trading course. Today we'll be taking a look at triangle patterns, how to trade them, where to place our stop losses, and what to look out for with each different type of triangle pattern. So we'll begin by the types of triangles. We have the symmetrical triangle, the ascending triangle, and the descending triangle. So these are the main three types of triangles that people trade in the market, and this is used by hedge fund managers and also bankers alike. So when you trade these kind of patterns, you're trading where the big money is, and that's where we want to be. So I'll begin by taking a look at a symmetrical triangle. So symmetrical triangles are formed by a descending resistance line and an ascending support line. There also signals a period of consolidation, and a breakout can occur either above the trendline resistance or below the trendline support. So we don't just generally have a bias on the trend when we're looking at these particular symmetrical triangles. We're just looking at which way it breaks. So in an ideal world, this is what a symmetrical triangle will look like. Price will become stuck within a point, and at some point we're going to be able to draw this top end line and bottom end line. Generally I like to draw it when it becomes obvious, so at least two touches. So 1, 2, or 1, 1, 2, 2, and at this point I would be liking to draw these particular lines. So we'll be looking for a break either above or below this area. So when it breaks past here, we'd be looking at potentially buying into the market, and if it breaks to the low point, we'd be looking at potentially selling into the market. It's important to realize this is an ideal world scenario. So what does it more likely look like? When we look at the charts, this is probably what we're going to more likely see. A series of lows and highs with a bunch of price movement inside. But again, we can follow the rules 1, 1, 2, 2, and then we can look to buy after we've drawn these triangles. Again, 1, 1, 2, 2, and then look to sell at this point if it breaks low. So let's just discuss the trading strategy behind these triangles, in particular symmetrical triangle. So we've identified the symmetrical triangle correctly. We know that we're going to look for a breakout on either side, and usually within the first 2/3 of the triangle it will happen. Then we'll look for the confirmed breakout, like here. We'll look to buy into this, or if it breaks to the low, we'll look to sell into this and profit from the decrease. But how do we project the take profit, or the profit levels, and where do we put our stops? So if we were buying here on the breakout to the high, we'd take the distance of the triangle at the formation of it, the start of the formation, and be projecting that out as our profit target level. We could also place our stop loss below the last low within the triangle. So you can see how this can be quite good for our risk reward strategies. We have a stop loss that's quite small with a take profit that's quite large. And again, it'll work on all time frames because it's a pattern. So you can use this on an hour time frame, a 4-hour time frame, even up to a monthly time frame on your charts. Let's now take a look at an ascending triangle. So an ascending triangle is formed by a flat resistance line and an ascending support line. It's a bullish pattern, and in most cases, a breakout will occur to the upside. So that's what we're looking for. So here we have our ideal scenario for what it should look like. A series of price making the same high and forming a resistance zone, and making a trend line on the bottom sloping upwards, with price being compressed slowly into this range. We're looking for a breakout to a high here. So this is an ideal scenario. Most likely though, we're going to be seeing something like this. So we'll see price make a high, it'll then make a low, it'll then make a high, it'll then make the low, and at this point we can start drawing because it's 1 touch, 2 touches, then we look to draw it. Same method applies. We can see the price breaks through a new high, so again, we'll be looking at buying into the market. And this is more typically what you're going to see. You're not always going to see the perfect looking charts in your charting software. So how do we trade this? We're again looking for a breakout to the upside. Then we look for the confirmed breakout. So we want a candle to close above the previous highs on whatever time frame we see the pattern on. And then we want to project the profit target and set the stop. So I like to, for this particular pattern, project around the middle point, so approximately 2/3 of the maximum height of the triangle as I take profit, and then set that as our profit target level with a stop below the last low. So we can see here we've placed it below this low, our stop, and our take profit level would be quite high, so it would be a great risk reward trade. So let's now take a look at the descending triangle. Descending triangles are formed by a descending resistance line and a flat support line. They're a bearish pattern, and in most cases a breakout will occur to the downside in these patterns. So here we have an ideal descending triangle, a series of lows at the same point forming our support line, where price is being kept within this trend line here and being compressed until it finally breaks to a new low. In a realistic world, this is probably what we're going to see: one touch, two touches, and then we would look at a break and trade this break to a new low. So let's look at the trading strategy. We're looking for a breakout to the downside. We're going to wait for confirmation of the breakout. So if we're trading a 1 hour chart, we're going to wait until the 1 hour chart closes below. That's very important. We need to make sure it closes. We'd sell into this market, and then we project our profit target and set stop by taking a 2/3 of the maximum height of the triangle, projecting that out as the profit target level with a stop below the previous high. So let's take a look now at some actual examples in the market of symmetrical triangle. Here we have the US dollar Japanese yen daily chart. You can see how price has been steadily being trapped, and we can draw this as a symmetrical triangle. We can then take the distance here when price breaks out and makes a new high at about this point here, and project that as our take profit. And you can see how successful these are to correctly, accurately identifying where we should be exiting the trade. And this is one of the most important things about patterns. You can correctly identify profit target levels and stop levels without having to guess. We'd place our stop loss below this low, and we'd be looking at a very high risk reward strategy. So let's now take a look at an ascending triangle example. See how price has been making steady increases over time. This is a Euro US dollar daily. Price has then reached this high, which has been unable to break, and it's been steadily increasing and getting trapped by this triangle, eventually breaking through on this candle. The way we do it is we take 2/3 of the height, we project that out, we place a stop below this low, and this would be about a 1-to-1 risk reward trade strategy. Here we have a decreasing market or a bearish market, the Australian dollar, New Zealand dollar daily. We've got our clear descending triangle here. We've got a break at this point after it's broken out the bottom of our triangle, and be looking at 2/3 as our profit target level. And you can see that many people are taking profit at this area. That's it for today, and we'll see you in the next video.